Hey friends, what are all the ways that you can make money through real estate? Wait, there's more than one way you can make money in real estate? Yes! Most people think, oh, I'm gonna buy a house and then I'll sell it down the road and I'll make a bunch of money. Well, there's actually 4 ways that you can make money through real estate: cash flow, appreciation, mortgage paydown, and tax benefits. Many call this the 4 quadrants of real estate investing. And when you're analyzing a deal, you want to make sure that you're accounting for as many of these as possible. Now, not all deals are gonna include all 4, but you want to make sure that you're accounting for as many as possible. Now, stay till the very end where I'll share a 5th way that you can make money through real estate as well. It's important that you're accounting for all 4 of these, because otherwise you might not be looking at the deal properly. You might be leaving money on the table, or it might not be a good investment. And depending on what your goals are, you might give more importance to certain aspects of the quadrant. For example, cash flow might be more important. But we'll touch on that more later on. Now let's get to the first way you make money in real estate: cash flow. Cash flow is the most important because it's the lifeline of your property and investment business. Now, some will say cash flow is not the most important, and that's because cash flow generally won't make you rich, it won't make you wealthy, and for the most part, it won't let you leave your 9 to 5, at least not right away. Now, if that's the case, then why does cash flow matter so much? Well, we need cash flow to maintain and sustain our properties. The more cash flow we have, the more staying power we have. And at the end of the day, we want our investment properties to be self-sustaining. The reason some people say cash flow doesn't matter is because they may already have high-paying jobs or businesses that are able to maintain those properties. A lot of people, what they'll do is they'll invest into condos in downtown Toronto or New York, where on its own, that property won't cash flow, but what they're hoping for is in the long run that those properties, the values of them will go up. Now, generally, that's only accounting for the appreciation side, which we'll get into, and it only works if property values are going up, which, as we've seen in 2022, that's not always the case. Now, where we see cash flow having a real impact is when we start looking outside the typical investment. Instead of looking at a home and just renting it out long term, if you convert it into a short-term rental, now that's where you have some opportunities for some massive cash flow. Another area is commercial real estate. Those properties generally won't even get financed by the bank unless you can prove to them that these properties are self-sustaining. If you look at a typical home, like let's say you buy a single family home, put 20% down and you cash flow it, it might only cash flow $200-300 a month. And if you really are trying to use that cash flow to replace your 9 to 5 job, let's say you're trying to produce $5,000 in cash flow, you might need 10 or more homes to be able to replace that $5,000. That's where you get strategies like Airbnb, short-term rentals, medium-term rentals, or commercial real estate, where your investment is able to produce a lot more cash flow. So how is cash flow calculated? Well, generally you take the rent that you collect, so your revenue, and you subtract all your expenses for the month and you get your monthly cash flow. Now, what most people don't do is they don't account for costs such as vacancy and repairs. If you've got a long-term rental, even, and this applies to short-term rentals as well, there might be times when your place is empty, for example, in between tenants. So you're not collecting revenue for those couple of weeks or that month. So you need to set aside money for that time period. And then the other thing is repairs. So let's say you've got a roof that's going to cost you $20,000 in 30 years. And if you're not accounting for these costs, then when you're analyzing a property, you might be like, oh wow, this is really great, this is cash flowing. But once you start to account for vacancies and repairs, you might quickly realize that the property you thought was a great cash flowing property is actually not, and it's losing you money every month. So that's why it's harder to find those properties that are actually cash flowing. Now, the second way that you make money through real estate is appreciation. Appreciation is when the value of that property goes up. There's generally 2 types of appreciation. The first one is market appreciation. So that's when the market that you're in generally goes up by, let's say, 2 or 3% per year. Generally, that's in areas where there's strong population growth, strong job growth, and it causes all the properties in that area to go up slowly. Now, at the same time, you could be in an area where people are leaving, jobs are leaving that state or city, and you might actually have negative market appreciation. So that's why the market that you're in is super important. The other type is forced appreciation. That's where you're more strategic with your renovations and are improving the property to force that appreciation. So for example, in Southern Ontario, conversions are really popular, where you take an existing single family home and you'll convert it into 2 or 3 units. The way it generally works is, let's say you invest $150,000 into those renovations, that'll end up with the property value increasing in value by about $200,000. Now at the same time, you might be thinking, okay, I'm going to invest $50,000 into this perfect bathroom. It's gonna have gold faucets, marble floors, custom lighting, but those renovations might not be strategic and might only improve the value of your property by, let's say, $10,000. So the type of renovations that you do and the quality of them is really important. Forced appreciation is a lot of what I do. Flips and conversions, where you take a home and you're applying those strategic renovations to improve that value. Mortgage paydown is essentially like forced savings. Every time you make a payment, it's going into your principal and interest. So every time you make that payment, every month, your principal amount is decreasing, which is essentially equity. The benefit of this mortgage paydown is that you owe the bank less and less every month. When you sell your home, instead of owing the bank, let's say $500,000, you might only owe them $450,000. Or if you're looking to refinance, you can actually pull that money out and use it for other opportunities. When homeowners talk about how much equity they're building, they're essentially talking about mortgage paydown. This is a point that's brought up quite a bit when people are talking about the benefits of buying versus renting. If you want me to go into more detail about this and make another video, let me know in the comments below. Now, the way that you make money through real estate is through the tax benefits. I won't spend too much time here because I'm a CPA, but I'm not a tax CPA. It's like asking a doctor to do a root canal. But essentially, real estate offers many benefits where you can defer the taxes on your profits. I won't get into the details now, but be sure to talk to a tax professional about your unique circumstance and situations. They'll be able to guide you on how to approach this properly. Okay, so we've talked about the 4 ways that you can make money in real estate. Now let's get to the 5th one, which often isn't talked about and which really lets you supercharge your results. It's called leverage. Let's take an example. You've got a $500,000 property, you invested 20%, which is $100,000, and the property goes up by 2%. Now, that $500,000 property, 2% of that is $10,000. So the property's gone up $10,000. But when we take that $10,000 and apply it to the $100,000 that you've invested, now that 2% has become 10%. So that's where you can really see the power of leverage and how it multiplies your returns. Now, if we take this a step further, this is where it becomes really magical. Let's say you have your one property, or even better, if you have multiple properties and you refinance them and turn them into more properties. It's essentially the monopoly strategy. You've got 4 red houses that you convert into the green hotel. Most investors will get stuck at that red house stage. They'll acquire multiple properties, 30, 40 properties, but what they won't do is they won't convert those into green hotels. Now, the benefit and the impact of having commercial real estate in your portfolio is huge. I strongly believe if you want an 8 or 9 figure net worth, you need to make commercial investing part of your strategy. I'll do another video on commercial real estate. If I were looking to invest right now, I'd be looking at small properties that are 2 to 4 units. The best part about real estate is that there's so many options. I'll do another video detailed later about what I'm doing, but depending on what your strategy is, you might use only one of the 4 ways to make money in real estate. For example, if you're doing a flip, most of the time, 90% of that return is coming through appreciation. You're buying a discounted property, you're putting strategic renovations into it, and you're selling it at a much higher amount through the forced appreciation that you've done. Another option, if you're looking at making cash flow, you might do an Airbnb. But again, depending on what you're looking to do, the strategy that you use in real estate will vary. If you found value in this video, then be sure to like and subscribe to the channel, where I share weekly videos on personal finance. See you all next week.